Money is limited, investment opportunities are not. Welcome to AKSHARAHA, an initiative by Anveshan Educational Trust. In this episode, we'll explore about average rate of return, its meaning, types, and problems. In previous class, we studied about capital budgeting methods. There are two methods in capital budgeting, non-discounting method and discounting method. In non-discounting method, the first method is payback period method, where payback period calculates the time required to recover the initial investment. In this class, we are going to study about ARR. ARR in financial management stands for accounting or average rate of return. ARR tells us how much profit a project earns. ARR tells us how much profit a project earns compared to the investment made. In simple words, ARR answers one question: is the project profitable based on accounting profit? To calculate ARR, we use two methods. One is original investment method and another one is average investment method. In original investment method, we use ARR is equal to annual average net profit after depreciation and tax divided by initial investment. So to calculate initial investment, we use the formula cost of equipment. It means cost of machinery or plant minus salvage. Salvage value is nothing but a scrap value. Divided by initial investment into 100. And in second method, let's come to ARR on average investment method. ARR is equal to annual average net profit after depreciation and tax divided by average investment into 100. Now let's solve the problem. Compute ARR from the following data. Cost of asset is 7 lakh rupees. Useful life is 5 years. Cash flow after tax, it means CFAT, is 2 lakh rupees. Now to solve the problem, note down these formulas. CFAT is equal to cash flow after tax. PBT, it means profit before tax, is equal to profit minus depreciation. PAT, profit after tax, is equal to profit before tax minus tax. So CFAT is equal to profit after tax plus depreciation. Now let's come to the computation part. Let's solve the problem. As we discussed, this is the ARR on original investment formula, annual average net profit after depreciation and tax divided by initial investment into 100. So to calculate initial investment, cost of equipment, machinery cost minus salvage value, it means scrap value. Now let's start with the calculation. CFAT is 2 lakh minus depreciation. Depreciation is 7 lakh divided by number of years. This 7 lakh is nothing but cost of asset. This value equals 7 lakh divided by 5 is 1 lakh 40,000. So 2 lakh minus 1 lakh 40,000 is nothing but 60,000. Now let's calculate ARR. ARR is equal to annual average net profit after depreciation and tax. Since there is no tax rate, we have not calculated tax. So this is the annual net profit. So profit is 60,000 divided by initial investment. What is the initial investment here? It's 7 lakh. So 60,000 divided by 7 lakh into 100. This gives to 8.57%. Now let's calculate ARR on average interest. Computation of ARR on average interest. The formula for computing ARR on average investment is ARR is equal to annual average profit after depreciation divided by average investment. So to calculate average investment, initial investment minus scrap value divided by 2 plus scrap value plus additional net working capital. First, let's calculate average investment. Average investment is equal to initial investment divided by 2. So what's the initial investment? It's 7 lakh divided by 2 is to 3 lakh 50,000. So this is our average investment. ARR is equal to, what's the annual average net profit after depreciation and tax? We have calculated in A. It's 60,000. So take that here. 60,000 divided by this amount, average 3 lakh 50,000 into 100 equals 17.14%. This is the answer. Now let's move to the second problem. Illustration 2. Project XYZ requires an investment of rupees 20 lakh and profit after depreciation as follows. Year 1 it's 2 lakh profit, year 2 it's 3 lakh profit, year 3 it's 4 lakh profit, and in year 4 it's 5 lakh profit. At the end of the 4th year, the machinery can be sold for rupees 1,20,000. Calculate ARR. Let's go with the solution. First, we'll calculate average net profit. Let's calculate average net profit. So, profit divided by number of years. Profit is what? 2 lakh. Add all these profits. 2 lakh plus 3 lakh plus 4 lakh plus 5 lakh. All divided by number of years. What's the number of years? It's 4. So add these and divided by 4. The answer is 10 lakh 25,000. So original investment is initial investment minus scrap value. What's the initial investment here? It's 20 lakh. So 20 lakh minus 1,20,000. It's 18 lakh 80,000. Therefore, ARR equals 10 lakh 25,000 whole divided by 18 lakh 80,000 into 100 equals 54.52%. Now let's go with the average net profit after depreciation and tax. Average investment. Let's calculate average investment. It's initial investment minus scrap value divided by 2 plus scrap value plus additional net working capital. If additional net working capital is not mentioned in the problem, leave it. Take this. What's the initial investment? It's 20 lakh. 20 lakh minus 1 lakh 20,000 divided by 2 plus scrap value. What is the scrap value? Again, it's 1 lakh 20,000. So the answer is 10 lakh 60,000. Now substitute. Annual average net profit is this amount. Annual average net profit is 10 lakh 25,000 whole divided by 10 lakh 60,000 into 100. What's the answer? The answer is 96.69%. Now let's move to the third illustration. Project X has an initial investment of rupees 3 lakh. Its profit before depreciation and tax for 5 years are 90,000, 1 lakh 10,000, 1 lakh 20,000, 1 lakh 20,000 and 70,000. The tax rate is 50%. Salvage value, it's nothing but a scrap value, it's 25,000. Additional working capital is 10,000. Calculate PBP and ARR. Those who have missed previous classes, please take a note of PBP. Calculation of PBP. Statement showing CFAT of cumulative CFAT. Year 1, 2, 3, 4, 5. Profits are 90,000, 1 lakh 10,000, 1 lakh 20,000, 1 lakh 20,000 and 70,000. Depreciation 3 lakh divided by 5. It means initial investment divided by number of years. Initial investment divided by number of years. It's 60,000, 60,000, 60,000, 60,000 and 60,000. For all 5 years, it's 60,000. Now let's calculate PBT, profit before tax. Profit minus depreciation is profit before tax. So 30,000, 50,000, 60,000, 60,000 and 10,000. PAT. PAT is equal to PBT minus tax. So it's PBT minus tax. What's the tax? It's 50%. Deduct 50% from this. 30,000 minus 50% is 15,000, 25,000, 30,000, 30,000 and 5,000. CFAT. CFAT is nothing but addition of PAT and depreciation. CFAT is nothing but addition of PAT plus depreciation. Add this. So what's the answer? 75,000 85,000, 90,000, 90,000 and 65,000. Cumulative CFAT. Add cumulative CFAT is nothing but addition of these two, this two, this two and this two. 75,000 you'll write as it is. 75,000 plus 85,000 is 1,60,000. 1,60,000 plus 90,000 is 2,50,000. 2,50,000 plus 90,000 is 3,40,000. 3,40,000 plus 65,000 is 4,05,000. Now calculation of payback period. So the formula is cumulative CFAT minus initial investment divided by CFAT. Now let's calculate payback period. What's the nearest number to 3 lakh? 3 lakh is nothing but initial investment. To recover 3 lakh, you have to take the nearest amount. It's in third year, year 3. So 3 year plus what's the cumulative CFAT of that year is 2,50,000. 2,50,000 2,50,000, it's nothing but third year CFAT, the nearest number to the 3 lakh, minus 3 lakh. This is nothing but initial investment divided by CFAT. CFAT of next year. That means 90,000. Fourth year CFAT equals, what's the difference between 2,50,000 and 3 lakh? It's 50,000 all divided by 90,000. This is nothing but 0.55 approximate to 6. So this takes 3 years. 3 years plus 6 months. So total 3.6 years. This is PBP calculation. Now let's move to number of years 1, 2, 3, 4 and 5. Profit before depreciation, it's nothing but these profits. 90,000, 1,10,000, 1,20,000, 1,20,000, 70,000. Now let's calculate depreciation. Depreciation is nothing but initial investment minus scrap value divided by number of years. So what's the initial investment here? It's 3 lakh minus scrap value is 25,000 all divided by number of years. It's 5. What's the answer? It's 55,000. 55,000. 55,000. 55,000. Apply same amount for all 5 years. And tax. What's the tax percentage? At 50%. Deduct 50%. Now let's calculate tax deduct tax at 50%. So 90,000 minus 55,000 is 35,000. 35,000. So 35,000 at 50% is 17,500. And remaining amount is 17,500. Profit minus depreciation is equal to PBT minus tax is equal to PAT. So now what's the profit before depreciation and tax? It's 90,000. 90,000 minus 55,000 is 35,000 at 50%. So 35,000 at 50% is what? 17,500. What's the remaining amount? 35,000 minus 17,500 is 17,500. 1,10,000. 1,10,000 minus 55,000 is 55,000. 55,000 at 10% is 27,500. What's the remaining amount? 27,500. So 1,20,000 minus 55,000 is 65,000. 65,000 65,000 at 50% is 32,500. So what's the remaining? 32,500. 1,22,000 minus 55,000 is same. So this is 32,500. 32,500. 70,000 minus 55,000. So what's the amount? 70,000 minus 55,000 is 15,000. 15,000 at 50% is 7,500. 7,500. Now let's calculate average investment. Initial investment minus scrap value divided by 2 plus scrap value plus additional net working capital. So initial investment is 3 lakh minus 25,000 whole divided by 2 plus 25,000 scrap value plus additional net working capital is 10,000. 3 lakh minus 25,000 divided by 2 is 1,37,500 plus 25,000 plus 10,000 equals 1,72,500. ARR, average net profit after depreciation tax divided by average investment into 100. So what is average net profit? It's add this to get net profit. So what's the net profit? It's 1,17,500. This is net profit. AP is equal to 1,17,500 divided by 5 equals 23,500. So final AP is Let's write here 23,500 divided by what's the average investment? It's 1,72,500 into 100. What's the answer? 13.62%. So this concludes your ARR. Thank you for watching the video. Please subscribe and press the bell icon for more videos.